For those of you that have joined, welcome everybody. We are not going to start the presentation quite yet. We're going to let those that are trickling in just kind of work their way into the webinar until I get a thumbs up from Ken on the backside. But for those of you that have joined, again, welcome. And we'll get the presentation started here in a little bit. Thank you. All right. It looks like we're good to go. So for starters, I wanted to introduce our speaker today, Bill Pagini. Bill joins us. He's a senior portfolio specialist with Vanguard, and Bill began his tenured career with Vanguard in 2008. Prior to his current role, he helped Vanguard advisor portfolio. He helped construct the Vanguard portfolio analytics and consulting offering. Bill also earned his finance degree from the University of Arizona, and he's a chartered financial analyst. Before I kick things over to Bill, I just wanted to introduce myself. For those that don't know me, my name is Alex Black. I'm an advisor with Integris Wealth Management. And I'd like to kick things over to Ken Cranstone just to talk a little bit about the webinar and some of the things internally while we go through the presentation today.
Thank you, Alex. I know no one can see me right now, but I am behind the scenes. Pay no attention to the man behind the curtain. If you're new to our Zoom webinars, just want to let you know that we really do love engagement as we go. At the bottom of your screen, you'll notice that there is a Q&A button. Go ahead and click on that. As you have questions, as you submit them, I'll be able to see them. We'll pass them along and funnel them over to Bill as the presentation goes. There may also be some time at the end to address any lingering questions. But again, we love that engagement. Feel free to ask questions. This is really your opportunity to get to speak with the experts here. But Alex, why don't you go ahead and take us back?
Perfect. Thanks, Ken. And finally, one last thing before I give things over to Bill. As always, with anything financial, there is a disclaimer. This presentation is intended for educational purposes and should not be considered investment advice. With that being said, Bill, I'd like to kick things over to you.
Great. Thanks, Alex. Appreciate that. Appreciate the introduction. Hey, everybody. Pleasure to be on the call today, talking a little bit about Vanguard's market, or I should say economic and market outlook. So, a couple things that we'll talk about today, really our look at, what the economy could look like. Certainly all eyes on the Fed, inflation, GDP growth. Also with a focus on our market outlook and our expectations for returns over the next 10 years. So looking over a longer time horizon. And then we can hit a little bit on some current topics. Right, as folks may be aware, we're in an election year. That tends to come with some questions about, how that impacts financial markets, what you should do, if anything, from a portfolio perspective. So we'll try to hit on all of that. So that'll be a little bit of our agenda today. I always do like to start out by just kind of framing like the purpose and the use case for doing these types of things, right? It's not to say, hey, you need to make a whole bunch of changes to a portfolio per se, but it's to better understand, what the year ahead could look like, be prepared for different scenarios that could play out, and ensuring that your portfolio is set up to really weather various different types of market environments, which is really the whole purpose behind creating balanced portfolios. So maybe even just to start there. I'll share some documents on my side to support some of this as well. The first one I like to share that I think is helpful is what we call a quilt chart. May have seen these in the past. Looks really complicated. Looks like there's a whole lot of stuff on the screen. But really what we're doing is just looking at each year from left to right and looking at a number of different asset classes. Basically ranked from the best performers at the top to the worst performers at the bottom. And what we've highlighted in red here is a 60-40 portfolio. That generally tends to be a decent representation of a lot of portfolios out there. but really more so just a proxy for a balanced portfolio that invests in both stocks and bonds. And really, I think illustrates the reasoning and the purpose behind doing that, right? So you can see that in any given year, the leadership changes quite a bit. You go from, in many cases, like emerging market equities, maybe an extreme example where you're at the top in many years, but you're also at the bottom in many years as well. And just shows that, hey, you want to capture those higher returns over time, but higher returns often come with volatility. So holding things like bonds, and ultimately having a more balanced portfolio gives you a more steady return that's more palatable, so you can stick with the plan and really ultimately achieve better results, quite frankly, with a balanced portfolio. Balanced portfolios came under a lot of threat in 2022 because bonds did so poorly. And that is one of the topics that we'll talk about. But really think that was an extraordinary year, and inflation is really one of the few things that can really derail returns for both stocks and bonds. So it was kind of a perfect storm in 2022, but we saw everything return to normal in 2023, where relationships are starting to normalize in the market again. So, I do all of that to kind of provide context going forward, which again, as I mentioned, like, we're not saying, hey, you should do things drastically different based on our outlook, but it helps form expectations and know what to expect out of different parts of the portfolio going forward. So let me see. So maybe just to hit on one of the other current topics, right? The election. So, and this is before we get into really our broader firm outlook, but with the election, it often comes questions of, one, people are usually concerned that the party opposite of the one that they support is the one that's going to come in office. And so that naturally brings trepidation that, that's going to hurt stock market returns, right? So that's whether you're a Democrat or Republican. If you're a Democrat, you fear if a Republican gets in office, everything's going to go south, and vice versa. If you're a Republican, you fear if a Democrat gets in office, a lot of time everything's going to go south. Basically what we're plotting here, I mean, this is sort of a simplistic chart, but it's just delineating the different presidential regimes, and looking at those various time frames. We're going back to the 70s, but just kind of showing that, hey, the stock market's pretty much been on an upward march through measurable history here in the U.S. And there's no discernible difference in whether it's blue or red. The president just frankly hasn't had that much impact on stock market returns in a negative or a positive way. Frankly, it's been really even split over time. On this chart on the left, really what we're doing is breaking that down year by year, what the returns have looked like in each year. Again, they're color coded blue and red based on the presidency. It goes back to 1936. And then on the right, that's just showing you, again, sort of the same data, but in the 4-year increments that correlate to presidential terms. So like all this, what we're saying, we've gone all the way back to like the 1860s, and gathering as much return data as we possibly can. And basically, it's shown that the average return for a Democrat and a Republican are essentially the same. I think Republicans have eked it out like a higher average return by maybe like 20 basis points, right? So like well within just the general margin of noise for a data point like that. So really the point is to say it doesn't matter who wins in terms of the overall impact on market returns. Not likely to have a bigger effect than the other things that we'll talk about today.
Bill,
Oh, yeah,
sorry,
go ahead,
but
Alex.
before you jump at, would you mind just clarifying for the audience what a basis point is?
Yeah, basis points. Yeah, good question. Good clarifier. 1 basis point is 1/100%. So when I say 20 basis points, I think the average for Republicans was about 8.1 on average versus Democrats at about 7.9. So we're just saying it's basically it's been so narrow over that time frame that it's not enough to say that there's a reasonable difference based on the fact of the presidential party and policy
Yeah.
in power.
No, and that's helpful to hear. I mean, I love this graphic on the left, especially compared to the first graphic you showed that just showed the long-term trend. I mean, when we talk about investing and we talk about with investing with clients, we really focus on that first graph, the long-term trend. Things go up over time, or at least historically they have. If you start to try to look at the noise, it's really hard to discern, which you can see from this chart on the left, that, there's some up and down periods, but who knows when they're going to happen. So really focusing on that long term is what we try to gear people towards.
Yeah, it's a great perspective. I mean, essentially, yeah, right. I mean, equities for the most part, obviously there's no guarantees, but you expect to have the
Yeah.
highest return over time. But the price that you pay for that is the noise. So, that's kind of that's the price you pay is the noise and the uncertainty in shorter time periods. Over longer time periods, you have a little bit more certainty around that. And that's why you help diversify that with bonds to sort of balance it out along the way.
Absolutely.
So let me start talking a little bit about our economic outlook. The economic outlook has been an interesting one. And certainly we can think a little bit more about the Fed as well. That's kind of where all questions are at these days, is like, what is the Fed going to do? That appears to obviously be driving markets quite a bit as well. But what I point out is, I think most economists over the last few years have gotten most things wrong in terms of, being fast enough in calling for rate increases and the rising inflation. I don't think a ton of people were really sounding the alarm bells that we thought it was going to be nearly as bad as what it was, that the Fed was going to need to hike as high as they were. And then last year, similarly, a lot of economists calling for recessions that didn't materialize. Now, along that way, I would say Vanguard was part of that too, right? I mean, I think we were generally like ahead of the curve in terms of being, a little bit concerned about inflation, the Fed needing to raise rates. But obviously, that's a very tough job. But similarly, we came into 2023 at the beginning of the year expecting a recession last year. We also came into the year this year expecting a recession this year. You'll actually see that reflected. You'll see my presentation is dated December 2023. And since then, our outlook has even changed to where we're not expecting a recession this year. So I always kind of joke that, the markets move faster than our compliance team. So in that case, like, our views have changed more quickly than we've gotten that worked into some of the materials. But I think it's actually an interesting exercise to look at what our expectations looked like in December and talk about how that's changed. So that's really where we'll start for the economy, right? We'll talk about monetary policy. I think that's ultimately a product, like what the Fed is going to do is dependent on what happens with the growth of the economy, employment rates and inflation. So I think a lot of times it's people's instinct to sort of start there, but I think it's actually more useful to end there because these other things serve as such an important input there. But again, we came in expecting a recession or at least a slowdown in the economy. So you can see that reflected in US GDP growth of less than 1% expectations. Now, we've since revised that to 2+%, so closer to basically trend-like growth in the economy. Unemployment, we were expecting 4.5% to 5%, which is still pretty modest relative to a slowdown in the economy. Usually you see like 6+% there. But nonetheless, that's an outcome of calling for a recession. We're now down to expecting closer to 4%. And then inflation, we're expecting to continue its march downward and end the year somewhere around 2.3, which quite frankly, a slowdown or a recession helps accelerate that decrease in inflation. So when you lose that and some of these other effects, We've now revised that higher, closer to about 2.8%, which is fairly substantial from an inflation standpoint. So, what does that all mean when it gets to the Fed and what the Fed is going to do? I always think it's important to reframe, like, the Fed has really two primary objectives. One is full employment in the economy, and two is low and stable inflation, price stability. So, and their target is 2%. So when inflation is higher than they want it to be, higher than where they're forecasting, where their expectations are, in other words, it's not coming down as quickly as they had wanted or hoped, they have to fight that with higher interest rates. Now, the one thing that can alter that is a lot of times with higher interest rates, you tend to slow down the economy, which has an effect on employment, and you start to see employment tick up. So in our case, basically what we're saying is that we expect inflation to remain, higher than they want, yet we expect unemployment to still basically, like, the economy to still maintain full employment essentially. So basically what I'm saying there is, like, there's not really much motivation for the Fed to cut rates in an environment where they need to have them high to fight inflation, but the economy is continuing to hold up and remain resilient. Said another way, they don't need to support the economy. And if they don't need to support the economy, but they need to fight inflation, then inflation is going to take that priority. And that's why we think the Fed is not going to cut this year. So
Bill,
I think the reason behind that is
just to give a sense to the audience, what is kind of a normal rate of unemployment for the US, and at least in your view, and I don't know if you feel comfortable answering this, at what point is it kind of, okay, like, this is excess unemployment and the Fed may consider some action?
Yeah, I mean, I think like a full employment, if you will, is typically considered around 4%. In the current economy, we're actually below that. So, we're at, if not exceeding, full employment, which, kind of leads to economic strength that we've seen. In terms of, like, what would cause the Fed to have to act, I mean, that's kind of hard to say, but there's a trade-off between the two, right? And there's a balancing act. So, I think there's a range of scenarios that we look at for the economy, right? Like, one is our base case, which is the one I've just presented.
Yeah.
But there's other outside situations that could happen too, where, like, the odds of a, quote, reinflationary environment is starting to creep in, which is that inflation actually picks back up, the economy continues to overheat, and the Fed actually has to raise rates in that situation. That's not necessarily one that we think is likely, but it's certainly within the realm of possibility. The other is a recession. Recession certainly can, have an impact that can, even though we don't expect one this year, like, the risks of a recession are certainly elevated just given where rates are. I describe rates like leaving a teenager home for the weekend. You don't know exactly what's going to happen or go wrong or be misplaced, but something is probably going to happen. And the longer you leave it in that scenario, the more likely something is to happen. You don't always know what that is. I guess that's the point. It's like
I like that
it's still
example.
so it's still somewhat uncertain, but again, a recession would cause inflation to come down, which would then probably trigger a Fed cut. So, I think if inflation stays high and employment starts to tick up, that's where the Fed has a real decision to make. I guess I'll put it that way. Because now there's a trade-off where they would need to cut rates to support the economy and employment, but that same thing might have less of an effect on inflation. And so that's where the rubber meets the road. And I guess the point is that we're just not there yet, because inflation is still the one thing that they're having to fight. They haven't had to really the concern of the economy, just yet. I mean, obviously, there's always concern that you're going to hurt the economy by keeping rates high, but they haven't had to actually deal with the consequences of that yet.
Thanks. Thank you.
So let's talk a little bit about the market outlook from that standpoint. And let's see. Sorry, I'm going to be flipping around here just to get to the charts that I like to use. But here we have equity valuations. So, and sorry, I woke up with a little bit of a throat scratch this morning, so I'm just going to spray some throat spray, so don't mind that. But so, the first thing I like to do is we'll start with equities. Again, we look 10 years out. We actually did an interesting exercise where we looked at short-term forecasts by analysts in the market. So we used Bloomberg. We looked back for 12 years and we looked at every analyst forecast that they tracked for 12 months. Like they tracked like a price target for the S&P 500. And we plotted a range between the lowest forecasted return and the highest forecasted return. And we did that for 12 years. And I know that the audience is probably muted, but I always like to throw that out as a quiz question. Like, how many years do you think the actual return on the S&P 500 fell anywhere even just within the highest expectation and the lowest expectation for 12 years? So maybe if people just want to think about that for a second, like what they might expect.
Oh, I can't believe it was anywhere close. The estimates had to be widely ranged. The actual results are typically a surprise, but maybe I'm wrong. I've been surprised before.
Yeah, so it fell within that range 3 times out of 12 years. So 25%, and I mean, and you're talking about the most pessimistic person and the most optimistic person. We talk about the pessimistic person either overshooting it or the optimistic person undershooting it. I think there's 2 points there. One is that very rarely does anybody get it right for any given single year period. And number 2, like most forecasts center somewhere around the averages, and you just very rarely ever get an average like return in the market. So we look out over 10 years because over 10 years, markets tend to follow fundamentals. In other words, like actual financial results, whereas in the short term, they tend to follow sentiment. In other words, expectations. If you look at the market today, like AI is a huge narrative. You're not necessarily, I mean, certainly NVIDIA has had incredible results, but not all the stocks that have been appreciating the last couple of years have necessarily seen results, but they're expected to have results from AI. And so that can sort of, cloud what happens with the market versus the actual financial results. So that's all just a little bit of why we look over 10-year periods. Now, valuations is one of the first things that we look at. That's what we're charting here. This is basically, this dark line is essentially the price you pay to invest in the stock market. That's the way you look at it. It's essentially the price divided by the earnings of the companies. And what this gray bar here represents is what we think the fair value is. In other words, that's what we think the value of the stock market should be if it reflected everything that we look at. So, one, it's to say, hey, the price that you pay, it matters. We're used to paying high prices for high quality. I think in most cases, like when we're shoppers, consumers, the stock market's the opposite. The higher the price is, generally, the more challenging your forward-looking results tend to become. So the fact that prices are pretty high right now on just an absolute basis, but they're also high relative to what we think the fair value is, which is primarily driven by interest rates and inflation. Basically, what we're saying is when you buy a company, you're buying their future cash flows, future earnings of that company. When interest rates and inflation are really high, it just like it eats into your purchasing power, it eats into the value of those future earnings, which means you probably shouldn't be willing to pay as much for it. And right now, the value is higher than what we think it should be. So that challenges our forward expectations for stocks. At the same time, our expectations for international stocks are substantially higher. So you can see the results on the right-hand side, about 3% higher. So this 8.1%, that's our expectation over the next 10 years average for stocks outside of the US, and a little over 5% is the expectation for stocks within the US. So again, more favorable outside of the US, both as a function of the price you're paying because prices are lower outside of the US, and also the cash flows that you're getting. You're getting, close to a 4% dividend from international stocks versus about a 2% dividend in the US. So that's actual cash flow that you're receiving today. So really, and then also the dollar. The dollar is very strong right now. We expect that to weaken over time. So those three things are a little bit more favorable for international equities. But I think the elephant in the room is 5.2%. That's like, I mean, I mentioned returns going back to the 1860s, and that's over 8%. But for the better part of the last century, it's been above 10%. So you're talking somewhere in the neighborhood of like half of historical returns based on what we are expecting. So I think, again, to get back to my earlier comments around like expectation setting, like I just wouldn't expect the next decade to look like the last decade did, especially in terms of getting these really powerful equity market returns, because it was one of the best decades we've ever seen in the stock market. So it's not to say to abandon stocks. It's just to say, hey, like let's just be aware of what the conditions look like and how that could impact things, but still be aware of all the uncertainty that exists. The next thing I like to talk about is bonds. 2022 was an exceptionally bad. It was actually the worst year on record for bonds. I mean, ever that we've ever recorded. So one, that's very extreme. Two, that had a real impact on your statements, right? Like the value of your portfolio, what you're seeing, especially in a balanced portfolio where that's meant to be the stabilizer. So what we're showing here in this dark line is essentially the value of a bond portfolio, of the average bond portfolio, using broad indexes, right? This teal line, what that represents is what our forward-looking forecast looked like when at the beginning of 2022, when we had really low interest rates, we hadn't had the sell-off in bonds, but your forward-looking return is based on the yield that you're getting in return, and that was just incredibly low. So you can see that blue line is sort of playing out where yields were at that time and where prices were. Now, what we see here is the sell-off that we all experienced in bonds. And then the tan line, what that's representing is the fact that we now have higher interest rates that we're getting as bond investors, and what forward-looking returns look like from the level that we're at. So there's two things to observe here. One, the tan line is steeper, meaning our return expectations are higher. Certainly that's a good thing. But I think the most important thing is that the tan line ends up in a place that is higher than the teal line. So basically what we're saying is over the long term, we'll all actually be better off for interest rates going up. Even though that had a negative impact in the short term on our bond portfolios, we expect bond investors to be better off at the end of the decade than they would have if that didn't happen. So I think that's just a little bit of a reframing, right? I think the other thing with bonds is, I think we all forget, like we look at banks, we say, oh, banks must just be doing so great because mortgage yields are so high, interest rates that they're charging on loans is so high. When you invest in bonds, you're actually the lender in that situation. So the point is, you are now capturing those yields as a bond investor. Even though we're all paying those higher yields for anywhere where you're financing anything, you're also getting those higher yields in return for your bond and investment portfolios. And we think investors will be better off over the long term because of that. And then, so maybe just to kind of wrap this up with, like, what do our expectations look like over the next decade? Here's, what we view as the four major asset classes. It's U.S. and international stocks, and it's U.S. and international bonds. We looked at the return expectations a little bit, but I would just point out that expectations are significantly lower than normal with U.S. equities. Now, again, I would say that doesn't mean abandon U.S. equities, because you don't know when those returns are going to come, and you can do more harm than good actually are more likely to do more harm than good by sitting out of equity markets, even when return expectations are lower. And remember, that's why you hold bonds. So I think that's the bright spot. Bond return expectations are higher than they've been for us in the last decade. That's actually what you see here. You see 3 bars. These are what our return expectations look like. Entering 2021, that would be the lightest bar. Entering 2022, or I should say the year end, right? So at the end of 2021, that would be the lightest bar. At the end of 2022, that would be the medium bar. And then the dark bar, essentially the end of last year, the most current forecast that we have. And what you've seen is, bonds in particular, the return expectations have crept higher and higher over that period, as have US returns, but you can see they just weren't very attractive even back then. So it's all about, I think, having balance in a portfolio, knowing the role that each asset plays within that portfolio, and really setting yourself up for both long-term returns, but also mitigating negative results along the way, as that can really challenge the resolve of an investor, and that's what it's meant to mitigate. So, I think, again, really a bright spot for bonds, and I would ultimately sum it up with something I mentioned a moment ago, which is in the next decade is likely to look a lot different from the last decade. Over the last decade, if you held U.S. stocks and nothing else, that's probably the best you could have done. As we look over the course of the next decade, we think these complementary components that you build on and complement equity portfolios with are going to play a much more important role. And those things are bonds as a major one, and stocks outside of the U.S. So that's kind of that's the story, is that, again, the next decade likely to look a lot different. But that doesn't mean you should be making material changes to the portfolio, just knowing what could potentially be on the horizon. And with that, Alex, I'm happy to wrap it up, and we can take any questions from the audience that anybody has.
Sure. No, absolutely.
Or if you have any questions on it.
We've got a few from the audience, and I just wanted to chime in. I think the message that you provided towards the end of that slide is wonderful. Just really making sure that your portfolio is designed for your specific objectives, goals, and needs, and diversification is really the answer. I loved the clip that you put in about, or I should say the plug that you put in about short-term market expectations versus long-term market expectations. At the end of the day, the short-term forecasts tend to be wrong, and wrong by a very wide margin. Even the long-term forecasts tend to get a little bit muddy, but the picture gets a little bit clearer. And the real question is, for investors, what do we do? If we don't really know what the short term is going to be, the people that are forecasting don't really know what things are going to end up like. How do we protect ourselves best? And what you just said, I think, is really the right answer, which is diversify in an appropriate way based on what your goals and objectives are.
Yeah, and it's quite frankly, it's not the kind of message that you're going to see a lot on like TV and in the media, because they like to portray really strong conviction in views, right? And so diversification doesn't, like to your point, doesn't tend to be as exciting, but it's really what all of us as practitioners are doing.
Well, and I mean, that's a fair question. I think, or it's a fair statement. I think it's a good segue into one of the questions, which is looking at the forecasts. Are there any expected differences in market performance as it relates to a political party or a power, either in either section of Congress, so either in the House or the Senate, or in terms of presidency?
Yeah, I mean, hopefully we addressed that kind of early on with some of the slides, but I mean, it's a tough game, right? I mean, there's two things you have to do. You got to think about who the party is coming into office, who the president is, what the policies they want to enact, their ability to get those policies enacted, what they say versus what they actually do, and what actually makes it into those bills. So there's just so many moving parts that it's it's difficult to predict either way. And then again, we just don't see that as being a primary driver of return differentials. Much more driven on what we're seeing from companies and their ability to produce earnings and growth tend to fall outside of the changes in governance.
That's such a good point. I mean, markets are driven by companies and earnings, and these companies at the end of the day are navigated by human beings, which we've been pretty good at adapting throughout our time here on this planet, and I think we'll continue to be. And in political party, I mean, regardless of what it is, human beings tend to adapt pretty well, regardless of the circumstances.
Yeah,
Uh,
again, just to kind of maybe hit on some of the stuff I talked about earlier,
yeah,
it's like the things we do look at when we forecast equities, right? It's somewhat simple. It's valuations, which is the price. It's earnings growth. So what your forecast on earnings growth looks like. It's dividend yield.
Mhm.
That's it for the U.S. Outside of the U.S., we also look at currencies, but nowhere in there, right, is political party. I mean, maybe
No.
there you could argue there's some that could have some impact on earnings growth, but again, it's a small unpredictable part of what you can forecast.
I think it's helpful just to reiterate that message, and I also think it leads into another question. So we're trying to take people back to the big picture here, but thinking about kind of what we're hearing when we talk to clients, it just seems like people feel like the economy is doing worse off than it actually is. But I mean, given the data that you just went through today, it seems like everything's fine. I mean, is there, and I really like one of the comments you made, which is there are still potential threats on the horizon, but it just hasn't materialized. And I guess, would you be willing to speak a little bit to maybe why people might be feeling that things are worse off than they actually are?
Yeah, it's a good question. It's something I a lot of times I open with actually. um, I'm a golfer, and there's this big saying in golf, which is like feel versus real, which maybe no real reason to bring that up other than that phrase of feel versus real. Like, what does the economy actually look like, but what do we feel? I mean, at the end of the day, we're all consumers, and right, prices have gone up dramatically. And then when
Yeah.
we're talking about decreases in inflation, we're not talking about prices going down. We're talking about prices growing more slowly. So I think that frankly is a big part of it, is like the purchasing power for pretty much everybody has gone down over
Yeah.
the last couple of years. Um, so I think that is frankly what is driving a big part of the feel of the economy, is just having higher prices everywhere you look, and just all of our experiences as consumers in the economy, regardless of sort of business results. And then the other thing is it's very much a bifurcated economy right now. I mean, I think I think you do have a lot of these mega cap, sort of gigantic growth and ultimately more tech-oriented economies or companies driving the market. Interest rates haven't really affected them because they don't need to issue debt. They have large cash balances. They can They can finance their own projects, and as a matter of fact, they're getting more yield on that cash that they have sitting on the sideline. So in some ways, it's not really hurting them all that much. Versus, say like construction or home building, right, where you have like these markedly higher prices as well as higher interest rates driving what people actually pay for homes. So you just have this. I think there's those two things. It's one, the effects we all feel of higher prices as consumers, and then two, this bifurcation of what's happening with not only with companies but also individuals. Right? You have some, like many individuals who are sitting on 2 to 3% mortgages, and then you have others who maybe are having to buy a home, maybe having to buy a first home, or having to move or relocate for a job and sell out of a mortgage that's 2-3% and buy into something that's, you know, not only more expensive but also at a higher interest rate. So um, I think it ultimately boils down to those two things.
That's really fair, and I want to go back to, but I also want to comment on what you just said. I have a question about something you just said, but I think it's important to really distinguish what inflation is, and it is a growth rate. It is not what prices currently are; it's how quickly prices will grow, and the expectation is that prices will continue to grow, but that, I mean, the prices that we're seeing are not expected to grow as quickly. That doesn't mean that the prices are going to go down. It means that this is kind of a new place, and people are adjusting. I think we're seeing some of those prices being reflected through various portions of the economy, or really that large inflation spike that we saw working its way through the economy in various ways. And I want to go back to what you were talking about, which was tech companies, and I think specifically tech companies inside of U.S. stocks. Is there any concern in your mind about the level of concentration that those represent inside of some of the larger indices?
So, yeah, there's probably a multifaceted answer there. Purely about the concentration, I would, you know, if I were to give a very short answer, it'd probably be no. If you look back over the last 100 years, about 90 companies out of, you know, tens of thousands have driven half of the returns in the U.S. market. So the U.S. market, just frankly, stock markets in general, tend to be concentrated and tend to be led by a small number of really big players. So in some ways, it's not necessarily something new. Now it's gotten a little bit more concentrated, especially over the last several years than it has been over the last decade. You know, it does start to do other things. I mean, one, large cap growth in the US. So a lot of those tech companies, I'm not going to single any specific company out, but large cap growth in the US is, in our view, the most overvalued segment of all of the markets that we look at. So that's where the challenge is. So it's not necessarily just the fact that markets are concentrated, but it's more so the fact that, you know, we think a lot of these names are some of the most overvalued, is what gives us some pause and concern. Now, I will say, like, we as a firm expect AI to be revolutionary for the economy. You know, we're comparing it to things such as like electricity, and you know, like communications, internet, things like that. That takes time to play out. There's likely to be, you know, many more winners than just the top few. In particular, we expect it to be a much more broad, like a general purpose technology that impacts, sort of lifts everybody up, like the users of it, not just the people that create it. A lot of times I compare it to the internet, like who created the internet, you know, other than maybe Al Gore, who likes to take credit for it, I guess.
Thank you for saying that.
But right, it's like you don't look back and, like, you know, we're looking at the winners today as the people who are really creating AI, or the first creators of AI, and sort of the picks and shovels, like NVIDIA, I would describe as like the picks and shovels, providing the infrastructure for it. Now they should be winners, but they're unlikely to be the only winners, or even necessarily the biggest winners when you look back in the future. So all that to say, you know, even with those expectations, it's all been driven into a small number of names. And so potentially driving some of that overvaluation that we're seeing, which is what gives us concern more so than just necessarily the fact of the market being concentrated.
No, that's fair. And I really like the comment about AI. I mean, just thinking about kind of how excited people are about it, it reminds me of the internet boom. And I think a lot of people remember names like AOL and Yahoo, and those were some originators in the space, Netscape, but those businesses are not necessarily around anymore. And while they were popular at that time, we haven't really seen them anymore inside of the market.
Yeah, I mean, that's perfect. That's an expansion of what I usually talk about there, right? It's like there's a concept called Amara's Law, I think it's an academic who established it, but we tend to overestimate the impacts of technology in the short term. So that would be, the dot-com bubble is a perfect example of that. The internet, everybody saw that as being transformational. It was transformational. But what happened is they started piling into a bunch of names that, that had a website attached to it, but nothing real beyond that. AOL, Yahoo, the big winners up front. Yeah, when you look back now, decades later, it's created some of the largest and most successful companies like Amazon,
Yeah.
Google, Facebook, which has had some ups and downs, but it's currently up. A lot of these companies have really leveraged and used the internet again, as opposed to the quote unquote creators.
No, that's so true. It really is. One other question, looks like a question about just kind of like measures of inflation. And I think what the question's getting at is you were mentioning kind of core inflation. I think it looks like there's other measures of inflation. Any particular reason why you were focusing on core inflation, or what should we be really paying attention to if we are hearing kind of things about inflation in the news?
Yeah, I mean, we tend to focus on core. The Fed tends to look a little bit more at core. They'll look at like PCE. It's basically like producer indexes versus consumer indexes. There's some subtle differences. I'd say the one thing of core versus headline is like food and energy prices are unpredictable and not necessarily related to as firmly to interest rates. So like that's just an area that's more volatile and the Fed is unlikely to have as much control over. So when you strip that out and you have the core components, you have more that the Fed the policy can potentially implement, and that is a little bit more easily understood and predicted than headline. So that's where we tend to focus our efforts. And then again, you get into some subtle nuances with what the Fed looks at, but there's also this instances of like looking at a static basket of the things you buy versus some of the substitutions you can make, right? For me, like I love to eat steak, but prices of beef have come up quite a bit. I find myself like not eating as much steak, eating more chicken and pork or things like that. Like that's an example where where even though beef prices might be really high, it doesn't necessarily work its way into the inflation print or the actual impact on households if they're substituting that for something else. So those tend to be measures that the Fed looks at as well.
Got it. That's helpful. And question came in about core. Are housing costs associated with core, or are housing costs inside of core inflation? Would you mind touching on that?
Yeah, shelter is definitely a component of it. It tends to be a lot more lagging, backward looking, but it is. So certainly rents and home prices are built into those measures of inflation. And quite frankly, that was one of the big components that was driving inflation, as much as it was as we saw a very rapid rise in home prices really across the country, leading to higher inflation.
That's helpful. And then another question, excuse me, just kind of talking about inflation in my head that leads to maybe some concerns of recession. I liked your teenager example for raised rates. But what are the prospects of other countries going into a recession if the U.S. does not?
Yeah, I mean, the U.S. has remained much more resilient than other economies. So, we're seeing some other countries actually entering or even coming out of a recession. So that's been one of the things we've seen since COVID is, it kind of felt like global economy was moving like more so in lockstep. There's some, there's big differences in the economies, but sort of moving rates going down or negative, basically across the globe all at the same time, then coming up all at the same time. We're now starting to see some bifurcation where, the U.S. is still at, hopefully what we see as peak rates. You're seeing cuts in areas like Europe and in Asia. So you're seeing some bifurcation around the globe in terms of what's happening with economies. The U.S. economy certainly can't prop up everybody. So we are seeing, different economies, handle the current period very differently. And some already going into recession, some already coming out of recession. Some especially like in emerging markets. Just a lot of, we're just seeing much more like dispersion, I guess, like just a wider range of how economies are doing at the moment, because they've all handled sort of the COVID, the inflationary, the monetary tightening, all a little bit differently.
Yeah, and having different tools at your disposal obviously gives you different choices. One last question before we shut down today's webinar, and I got to ask Bill, what are the odds we get a rate cut in 24?
The odds.
The odds.
That's a tough one. I would say less than 50%. I mean, given our base case, again, it's all dependent on the economy and inflation. So we do think that there's still somewhere between, like, call it 15 to 25% chance that we have some sort of slowdown or a recession, which that could be the type of event. I mean, in a normal year, it's about 5%. So even though we're not expecting it, it's still a higher risk. Again, given the teenager example I gave you earlier. So, I would probably put the odds of a cut in our outlook would probably be closely aligned with those odds, right? Like if we see a recession, now the Fed has more reason to cut. If you see a recession or a slowdown, you'd also probably see inflation come down a little bit more sharply. So those are the types of things that could lead to a cut. And again, we put that somewhere like, I would say like, 25%, give or take.
That's helpful. I appreciate that. And I think that's a good way to close today's webinar. Bill, thank you so much. And Ken, thank you for following this up. Thank you all for your attendance today. We very much appreciate it. And I hope you found the information that Bill shared with you and the commentary valuable. Thank you all again.
Great. Thanks for having me. Appreciate it.